Somewhere right now, a financial news headline is telling you that the stock market is falling and that you should be very concerned about it. Or maybe the market is at all-time highs and the headlines are telling you a crash is coming. The financial media has an extraordinary gift for making every single market environment feel like an emergency requiring your immediate attention. Here's what most people who watch that coverage don't have: a clear picture of what market declines have actually looked like throughout history. Not the narrative, not the fear, not the dramatic graphics, the actual numbers. How often declines happen, how long they last, how bad they get, and what tends to happen immediately after. My name is Eddie, and I spend way too much time thinking about money, market history, and the psychology that makes normal market behavior feel catastrophic. If you want to understand what market corrections and crashes actually look like when you zoom out and look at the data without the news cycle attached to it, hit subscribe and give this video a thumbs up if it helps. If you've ever panicked during a market decline or felt the urge to sell when prices dropped, this video is specifically for you. Hit the like button. Let me start with some definitions. A market correction is technically a decline of 10% or more from a recent peak. A bear market is a decline of 20% or more. These are the two thresholds most commonly used in financial discussions, though neither represents some fundamental change in market character. They're just convenient reference points. Now here's the first number that surprises most people. Market corrections, 10% declines, happen on average roughly once per year. Not once a decade. Once a year. The US stock market has experienced a 10% pullback in about 36 of the past 50+ years. If you've been invested for 20 years, you've lived through approximately 15 to 20 corrections. Many of them you probably don't even remember now. The average correction involves a decline of about 13 to 14% from the peak. The average duration, from peak to trough, is about 4 months. The average recovery time, from the bottom back to the previous high, is also roughly 4 months. In the span of a year, the average correction starts, falls, and recovers, often without any lasting damage to long-term investors. Bear markets are less frequent but more severe. Over the past century, major bear markets have occurred roughly once every 3.5 to 4 years. The average bear market decline is about 33%. The average duration is roughly 13 months. Recovery from bear markets takes longer, sometimes 2 to 3 years to fully recover, though this varies widely depending on the severity of the decline and the economic circumstances driving it. The 2008 financial crisis bear market was exceptional by historical standards. The S&P 500 fell about 57% from peak to trough. Recovery took roughly 4 years to reach the previous high. This is the scenario that lives in most investors' nightmares, and understandably so. But it's important to recognize that 2008 was an outlier, not a template. The average bear market is considerably less severe and shorter-lived. If this historical context is useful, hit the like button and subscribe. I cover market history and investor psychology pretty regularly, and it really does change how you experience these events. Here's the really important part that most people get wrong about market declines. They are not the exception in a normally rising market. They are a structural, recurring, unavoidable feature of how equity markets work. Stocks earn their premium over cash and bonds precisely because they are volatile. The price you pay for higher long-run returns is tolerating periods where your portfolio is down 20%, 30%, or 40% and looking at a balance that's significantly lower than its peak. If volatility were eliminated, if stocks never dropped, their expected return would also be eliminated. The decline is not a malfunction. It is the mechanism. Investors earn higher long-run returns because they are willing to hold through the declines. The moment you sell during a correction or bear market, you convert a temporary paper loss into a permanent real loss and remove yourself from the subsequent recovery. The data on missing the best days in the market is some of the most compelling in all of investing. JP Morgan's annual guide to the markets has shown repeatedly that if you were invested in the S&P 500 for the full 20-year period from 2003 to 2022 and you missed just the 10 best single trading days, your total return would be roughly cut in half compared to simply staying invested. 10 days out of 5,000 trading days. And the worst possible time to be out of the market is during and immediately after a crisis, because the 10 best days in markets tend to cluster around the 10 worst days. They are the same events. The January 2009 recovery day, the March 2020 recovery, these happened without warning, after sharp declines, when market sentiment was at its most negative. The investors who had sold to avoid further losses were sitting in cash when the best single-day returns in years occurred. The investors who stayed invested barely noticed those individual days because they were part of a continuous holding. What does the historical record tell us we should actually do during market corrections? The honest answer is almost nothing different from what you were doing before. Continue your regular contributions if you're in accumulation. If you have extra cash and a long time horizon, declines are actually discounts on future wealth. The same index funds you were going to buy are temporarily cheaper. Don't change your asset allocation based on short-term market movements. Review whether your allocation was appropriate for your risk tolerance before the decline, and if it wasn't, adjust it during a calm period, not in the middle of a crisis. The reason most people fail to do this is emotional, not analytical. When your portfolio is down 30% and every headline is telling you it could get worse, do nothing feels reckless. Selling feels like taking back control. But the historical data is unambiguous. Investors who stay invested through corrections and bear markets almost universally outperform those who attempt to time the exits and re-entries. The cost of being wrong about re-entry timing is enormous, and most people are wrong about it. Market corrections aren't what the news makes them feel like. They're not rare catastrophes. They're recurring, temporary, fully expected features of investing in equities. The investors who build significant long-term wealth are almost always the ones who understood this before a correction arrived and held the line when it happened. If this changed how you're thinking about the next time markets drop, and they will drop, share this with someone who needs to hear it, subscribe if you're not already, and hit that like button on the way out. See you in the next one.